So hi everyone, we'll get started in just letting the last people through the lobby who are still joining to start in a little moment. But yeah, thanks for joining everybody. All right. In the interest of time, so thanks everyone who's joined on time. There's a few people just see jumping out of previous meetings or whatever joining us. But welcome today to the financial reporting update focused on December year ends. But if you're a junior end, doesn't mean you have to jump off the call right now. There's a lot of stuff that will be applicable to you also in June 25. For those of you I haven't met, so my name's Jeff Tolk. I'm one of the audit partners here at Saylor Dawson, and I oversee sort of everything related to financial reporting, some governance stuff, and obviously our quality control that links in with that as well. Joining me on the call on the session today is Matthew Crouch. He's one of the partners who we met. He is probably going to sit in the background. But if you have questions today, please put them in the Q&A as opposed to the chat, and Matt will answer those questions as we go, so you don't have to wait to the end. However, if I do a poor job at explaining something and a whole lot of you ask a similar question, we might round back to that at the end and jump on and answer it. Ask me the question and I'll answer it. So please feel free to get you a little bit of free advice by adding your questions to the Q&A. Before I kick off, I just want to say thank you very much. And there's obviously a number of clients, contacts on this call. I really just want to say thanks for your support, and really overwhelmingly we enjoy working with the vast majority of our clients. And I'll forget to do this at the end, so I just want to up front just wish you all a Merry Christmas, and hopefully you all get some restful, joyful break for those December year ends who are sort of rushing back with tight deadlines. That may be a bit shortened, but again, on behalf of the firm and ourselves, we just really want to wish you a Merry Christmas and the best, and like I said, a joyful festive season as well. So kicking it off, there's a number of things I'm going to talk through today. So in effect, what's new, should probably change the order a little bit, but look at what's happening in the future, circle back to related parties. So I've changed those two around. Talk about sustainability reporting briefly. And then at the end, I've left Tier 3 reporting will be at the end. So Tier 3 reporting is for not-for-profits only. The other bits are for everybody. And so if you're one of our for-profit clients, please feel free to exit at that Tier 3 point because it will not apply to for-profit. So that's what's on the agenda. So kicking off, let's start with what's new for 2024. And many of you will be pleased to know, well, it's actually not a lot. There's not a significant amount of new things. There's a few things. Why is that? The reality is that both the Australian Accounting Standards Board, the Auditing Standards Board, and Treasury have been really focused on a couple of things, and that's sustainability reporting, which I'll touch on and do some high-level information around that. And at the AASB, there's big not-for-profit project, which is Tier 3. So between those two things, that's kept the regulators or the standards boards really busy. And so there's also not a significant amount driving out from international at the moment, particularly with short application dates. And so we've got a bit of time around what's coming pieces, but I will go through them at a high level. So let's talk about what's new. The first thing, there was some, just before 30 June this year, there was release from changes to the Corps Act around what's called the Consolidated Interdisclosure Statement. It's a tax disclosure statement in reality, but dropped it into the Corps Act. all public companies that report under the Corporations Act. So that is public listed companies, public unlisted companies, but also companies limited by guarantee that report under the Corporations Act need to include this statement. So just to clarify, if you're an ACNC charity on this call, you do not report under Chapter 2M of the Corporations Act, you report under the ACNC Act. So this doesn't apply to you. Health charity, education type charities, religious charities, this does not apply to you. However, if you're a sporting club or something like that, and you report under the Corps Act because you're not an ACNC charity, this applies. Regardless, if you have no subsidiaries and you don't operate outside Australia. So it was a pretty blunt instrument that probably brought a fair bit of red tape to a lot of organisations that just isn't really applicable for. However, ASIC were required just to implement because the laws have already been through Parliament. So it is what it is. So these consolidated entity disclosure statement, what is it? It's for annual reporting periods after 1 July. So our June client base applied it. If you're December year end, you're about to apply it. In effect, if you have subsidiaries or entities you control, you will need to include a table like this around what sort of entity is it, where is its tax residency and its place of incorporation, and what sort of ownership interest do you have. It is a separate statement that goes right at the very end of your financial report. And also, so it does form part of your financial report. So along with that, if you don't have any subsidiaries, you still need to have a statement with this type of heading in it, but you will say that you don't have any. So you can then have it in effect on one sentence requirement. But I'm sorry, I've just added a page to your financial report even so. What else? There is a director's declaration required. So you make a statement. If you're a director in the room, you will make a statement that the consolidated disclosure statement is true and correct, in addition to the other statements you made about your financial report being true and fair, etc. If there's any listed public companies in the room, or on this call, they also need a sign off around the chief CEO, CFO, similar to other declarations listed corporations, those officers in the listed entity space make around the rest of the financial report also. And the new statement does form part of the audit report. The audit report mentions it as well, but not to the same extent that the director's report does. So that's the consolidated entity disclosure statement. It will impact you if you've got those overseas subs. There's some complexity in relation to which tax jurisdiction do some subsidiaries sit in, but if you've got sort of some complexity around that, please come and ask us. I don't think there'll be too many of people on this even. Next change is changes to AASB 101. So there was some implemented changes. They're actually effective 1 January 23, so became effective last year in reality, but certainly will be picked up in the June year end, December year ends this year. That removes the key part is within the definitions of a liability. To be a non-current liability, previously there was this requirement that you had unconditional legal right to defer payment or settlement of that obligation. Otherwise, it was current. This was problematic in Australia, particularly around banking arrangements, which often had annual review type clauses, which had allowed a bank to, in effect, change the level of principal repayment, demand repayment, etc., even though it wasn't written as explicitly that. When you got into the detail, it gave banks a lot of rights. That word unconditional has now been removed from the standard. And so now you just have to have a right. And so where you have a multi-year arrangement, it's far more likely that you'll get to non-current than you used to under AASB. There's also some additional changes in requirements, particularly around covenants, where you've breached those covenants, what action you need to take pre-year end to still get to non-current if that's important to you or an objective of yours. In addition to that, there's some additional disclosure information. So information about covenants, including the nature of covenants, and when you need to comply with them and the various liabilities they relate to, but also a disclosure around facts and circumstances that indicate if you have difficulty in applying with covenants. So, for example, we've had to take some specific action to avoid breaching a covenant post year end and things like that. So wherever you've got a banking arrangement now, there's different tests for current, non-current, and there's likely more disclosure around your actual covenants and what requirements you have there. So that's the ASB 101 change that is effective now. Additional changes in relation to 101 is also a change that we now don't have significant accounting policies, now refers to what as a material accounting policy. So at the very minimum, we'll be changing those headings in your reporting template around here's this list of accounting policies. They will now be called material. There's other parts of directors' declarations, etc., that used to refer to significant, will now refer to material. So that's the bare minimum change that anyone will have to make. But practically, it also means that where you have accounting policies within your financial reporting template that really are just a restatement of what the accounting standard says, perhaps don't relate to material balances or information that could reasonably influence a decision maker, you've really got far more scope to pull them out or reduce them down and be quite specific about what your policies are rather than repeating accounting standards. So ability to perhaps shorten up and make your financial reports a bit more readable and a bit more understandable to your user base. So we haven't seen a lot of people taking that change up and trying to push the limits there. We've certainly seen some reducing down some long policies around financial instruments, revenue recognition. A couple of other items that we've seen where there has been some changes. So firstly, where you have supplier finance arrangements, so where you buy something from a supplier, that they finance that, and you also get financing of that purchase. There's some additional disclosures. And then there's a IFRIC Interpretations Committee. This is an international committee that gives interpretation decisions for complex matters or matters where there's a divergence of accounting treatment under IFRS. They release a number of these during the year. You sometimes would hear me talk about them. Often they're highly technical and probably don't apply to the people on this webinar. So I don't mention many, but I would just mention one in the current where you're acquiring a business or a business combination. It could be or an operation, even not-for-profit, it's the same. You can acquire another organisation. If you have some sort of length of tenure or performance-linked amount of the consideration for the purchase that is usually to previous owners or key management personnel or something like that. The IFRIC has confirmed that they will always be considered remuneration for future services rather than purchase consideration. So those amounts don't get included in the calculation of goodwill, and that means they end up as an expense going forward. So there's been differences of views around that, but that's been clarified by IFRIC now. So some of you that may apply to some. A couple of other sort of regulator type things. So just note that the state thresholds in Victoria have changed for incorporated associations to align with the ACNC thresholds for small, medium and large. So again, no reporting obligation if you turn over less than $500,000. And then you're in the medium category, $500,000 to $3 million when you fall into the audit category. Do note as an aside as well, fundraising rules slowly changing and improving. So Queensland has got on board with reduction around some of that fundraising red tape or requirements where notification of the ACNC is required rather than a whole lot of registration and other reporting. So they're the main, that's like I said, there's not a lot, but they are the key ones for the current period. So your December report they're the key changes that you really need to be aware of. I just want to circle back and talk a little bit about related parties. So related parties, there's been uplift in the expectation. So just as a reminder, if you're a for-profit lodging accounts with ASIC in the room, you should already be general purpose. There is no special purpose for for-profits anymore. And therefore, you should already be complying with the full related party standard. For ACNC type charities, or other not-for-profits that report under the Corps Act, special purpose still exists for those entities. And so there are requirements, whether you're a medium or large charity, to comply with the requirements of AASB 124. So that came in from 30 June 23. There are some carve-outs for medium, not having to do KMP remuneration, or large if you only have one remunerated KMP. There's some exclusions from the requirements there. This was a big change, particularly for special purpose, dragging always, and for when special purpose got removed for for-profits, in effect, dragging many more entities into related party disclosure. And so that's had some teething difficulties and working through issues around how would you disclose, what's material, etc. So a couple of other things, just as I sort of walk on. Do note small charities, so you don't have a reporting requirement, but you do have to report in the IRS. And BRCs, basically charities, don't have reporting requirements. So I just wanted to remind you of those requirements, but specifically pick up the ACNC has been publishing some results of some of their reviews, some common issues end up in the commissioner's sort of newsletter things and those sort of things. And what they're saying in our meetings with them is that users, including the media, are reviewing the information in the AIS, which requires you to disclose the number of key management personnel, whereas the financial statements actually don't require the number, they just require a dollar. And what the ACNC is getting multiple questions, queries around inconsistencies between the financial report and, in effect, the AIS or AFR portion of the AIS. And so it just reminds you around that the ACNC does seem to respond to sort of these media questions, queries, etc. Ends up back with the charity trying to clarify which one is correct between those two, which may mean updating the AIS. More often it's updating the AIS, but it could mean updating the financial report to get consistency around that. And just remind you that it certainly is on the media radar around key management personnel, level of remuneration, and those type of disclosures. And so just be mindful of making sure you get those consistently correct and accurately supported as well across those two pieces of information. So moving on from that, I'm now going to sort of flick into future changes. So what's on the radar, what's coming? And there's a couple of things. So I'm going to start off with accounting standards, and then I will jump into sustainability in a little while as well. So the most significant change coming is still a little way off, but it's the introduction of IFRS 18, which will become AASB 18. And it will replace AASB 101. So for those of you a bit familiar with accounting standards, it is the foundational standard of what goes into a financial report. So it includes things like structure of the profit and loss statement. What does a balance sheet look like? The requirements around statements of change in equity. It also references back to what's current, non-current, what gets disaggregated, what goes where in a financial report, what do the notes need to look like, etc. So AASB 18 or IFRS 18 changes some of those things. And so it is quite a reasonable change. I don't think it's necessarily highly complex for a lot of you who are listening to this, but there's a bit in it. And certainly some changes of templates and changes the way we think about how you might communicate results and what things might look like for you going forward, particularly in your profit and loss, and we'll show you why in a minute. So application, apply from 1 January 27, so it's 2028. For December year ends, 29. The AASB is actually going to do some not-for-profit outreach next year in relation to this standard. And so as we've seen with a number of standards being introduced, particularly around leases, revenue, etc., the not-for-profit's got an extra year before application became mandatory. It's highly likely to get an extra year. And so this is a fair way out before the change actually occurs or is mandatory. I think we might see some early adoption for some organisations who like the new layout. So speaking of which, this is what the income statement will look like in the future. So it's in effect being divided up, giving the same type of headings as you'd see and be familiar with cash flow. So there's this concept of what's operating before investing and financing activities. And so then you will have investing and financing sections of your profit and loss statement. However, it is quite prescriptive around what can go in those investing and financing sections. You do not have a lot of choice or judgment involved in those. And so the default is that if you're not clearly allowed to have these items or required to have these items in investing and financing, it ends up in operating. And so there will be things where we have clients, or you see in sets of financials where organisations sort of want to do an operating profit and then something else sort of below that line to clearly distinguish it. Often it's about fair value movements in investment portfolios and things like that. So they will end up in investing. But there are other things, sort of ceased operations, redundancies, sort of those sort of things where they're saying this is not an ongoing, this is a genuine one-off cost. You cannot put that right down below these lines. So there's a little bit of scope with you up in that operating section, but outside of that, there's less scope for that going forward. I do note that investing, the categories for cash flow and the P&L are not the same. So investing in the P&L will be income from investments. And so those items, so dividends, interest income, fair value movements in investment portfolios, those type of things are investing income. However, investing in the cash flow includes where you invest in property, plant, and equipment, for example. But depreciation expense, which relates to that property, plant, and equipment, that's an operating expense or an operating activity from a P&L perspective. So you don't quite get, if it's in the cash flow, it's therefore the related item is in the P&L in the same category. It is a little bit different. I do note there are some changes to the cash flow where interest and dividend income and those sort of things, where there's choice between operating and investing cash flows. So that will get clarified and become investing cash flows, both in the cash flow as well, I understand. Where you actually have complex operations, particularly where you have complex financial instruments, and you have some complexity within your P&L and your activities, your balance sheet, this standard, it becomes more complex. But where you don't have significant amounts of complexity, I think the adoption of this outside that formatting will be relatively straightforward. So I will address some of the complexity in future webinars, but given the timeframes for adoption, I think if I started to address some of that now, you would all forget by the time we got round to adopting. And so I will leave that for future periods and just leave it there. But if you have really specific questions, or once the standard is available for early adoption, I will start to address some of those complexities around aggregation, etc. I do note, and I should have picked it up right at the beginning, that there is some opportunity or requirement where you report profit and loss measures. So think things like EBITDA, or you have some sort of profit before or operating profit before these one-off costs or some other form where you think that's useful, reliable measurement. ASIC's probably taken the view historically that put that up in the director's report and make sure you explain it, be really consistent. The new IFRS 18 allows that type of disclosure, and it calls the management defined performance measures to form part of the financial report, and so that you can do that subtotally. However, there's some really tight guidelines around reconciliation of that, consistency of that, explanation as to why you want to include that, and really limits your ability to chop and change it. So that may be of interest or requirement for some of you, but it is really clearly defined and controlled going forward under IFRS 18. So that's this management defined performance measure part of that standard. All right, I will move on from that and jump over now to sustainability reporting. So I'm just going to talk high level and give you an update of exactly where we're at, as opposed to getting to the practicalities of dealing with sustainability reporting. But where are we at? So again, supplies is particularly for the for-profits in the room, but don't tune out if you're a not-for-profit. There's probably some stuff for you to think about. That's right. So what's happened is, as if you've come to previous webinars that I've done for June and then even last December, I was probably starting to talk about sustainability reporting. So the legal act, the act has been passed and received royal assent in September. So that was a pretty rapid period that came in. It sort of was not on the radars, and then it really came rapidly. The AASB, Accounting Standards Board, and the Auditing Standards Board have been pedaling really hard to get there and understand, provide guidance and the standards to enable sustainability reporting to be adopted in Australia. So what does it do? It mandates climate-related financial disclosures for large businesses and financial institutions. And to be clear, and that they will be required to be those disclosures and metric measurements will need to be in a separate sustainability report that often is attached to accompanies the financial report. It is based on international standards, but in Australia, we've really adopted only the climate portion of that. So it's not things like biodiversity or rewilding or anything like that. It really is focused on impacts of climate change and carbon or greenhouse gas emissions. So it's a narrower scope than what some international jurisdictions have adopted. And I note that assurance or some sort of audit reports will be required. So why is sustainability coming in? It's to support, so the arguments are that it supports investment decision making, provides globally comparable information because we're adopting the global framework. It addresses a number of the issues that ASIC and others have been raising around voluntary reporting, which is quite fragmented. Everyone's doing things a little bit differently. It's more, some are doing sustainability, others are doing more carbon or greenhouse gas or climate-related disclosures only. And there was concerns around if it's not a standardised and regulated framework, that organisations claiming green credentials or greenwashing was problematic. And so we didn't have consistent and comparable information, and this seeks to address that. So when does it happen? So, or who's in first, I guess, is everyone who reports under Chapter 2M of the Corps Act and falls within these size thresholds. I've given the core ones here. There's a couple of others for fund managers. but you should be across it if you're in those really large categories of sort of billions under management and things like that. So the majority of SMEs will not fall. And I note that, again, charities that report under Chapter 2, and charities that are registered with the ACNC do not report under the Corps Act. You report under the ACNC Act, and so you're not within these categories. So and I've got that on the next slide for completeness, actually. So this has come in rapidly, and we're about to enter the first organisations in. So Group 1, commencing 1 January 2025, if you have 2 or more of those thresholds, so $1 billion in assets, 500 million in revenue, or over 500 employees, so you are in 2 or more of those, you are in, and you need to start to get your skates on. Group 2 is that lowest reporting threshold, and Group 3 is in effect the large proprietary company threshold under the Corps Act already. So that's what the third group is. I think on this call we probably have some Group 3s. It's possible we have 1 or 2 Group 2s, but not many. And so most people on this call or this webinar, you have some time and you get to see what others are doing before you have to start reporting. So again, just a reminder, if you're ACNC charity or you're exempt through other classic asset class orders, for example, overseas subsidiaries are not of a certain size, don't have to report. I do note that there is a materiality exemption under these requirements, and so you will not have to report or report in full, and I'll explain what I mean by that in a moment, if you do not have material risk to climate, in effect, climate change, risk and opportunity to climate change. You don't have to do the full lot of reporting. Now, what is material climate risk and opportunities versus what is not is probably something that we're waiting to see some more examples of, some further guidance around, etc. And so it is quite possible if you're a large proprietary limited company in the room, in particular that Group 3, that you will not have to necessarily go all the way, but we're really waiting for some guidance around that. So you will still need to articulate your climate risks and opportunities. However, if you determine that they are not material, and materiality links back to a financial concept, you don't have to then do the remaining disclosures around, in effect, greenhouse gas emissions, etc., and those other metrics. So, what does that mean? So, if you're determined that you don't have material risks, you don't have to do the metrics and targets piece, and you probably don't have to do the strategy piece, but you need to do the governance risk piece. If you do have material climate related risk, and we're not talking about material climate related risk, think about movement in average temperatures, those sort of things. So the 1.5 degrees or 2.5 degrees, if climate changes to that extent, what is the material, what are those risks and opportunities that apply to your organisation? So that's the concept of around those risks, opportunities. So it is a little bit similar to the annual financial report. It will include a statement around your risks, will include statements around your strategy, governance, what are your controls and risk management. There will be notes to the statements as well as a director's declaration, and over time, a assurance of that as well. So we have a staggered implementation based on size, and then we will have staggered implementation of some of these requirements. So I'll talk about some of these metrics, scope 1, 2, 3 emissions, just if you haven't really followed this at all. What am I talking about? I will explain that briefly, not around how you measure. But in your initial years, year of application, you only need scope 1 and 2 metrics. And after that, you will need full rollout where you in effect include scope 3. Likewise, there's a lower level of assurance required in the initial application, moving up to in effect a full or reasonable assurance sign off by an auditor after in the years after you implement. So I haven't put up the full table yet, but I probably will start to do that in future. So just to define, so if you're in this framework, or you could think about applying voluntarily, scope 1 emissions are the direct emissions that are owned or controlled by the entity. So what does that really mean? These are where you in effect burn a fossil fuel. So where you have a fleet of vehicles that aren't electric powered, you're burning petrol, LPG, or whatever your diesel, whatever your vehicles run on. You might have some property related gas sort of inputs, potentially around both gas appliances or gas based property plant equipment. Likewise, things like air conditioning can result in greenhouse gas type emissions also. So that'd be scope 1. Scope 2 is in effect the electricity that you use. So other energy inputs that you use that you don't produce yourself, emissions from those. And then scope 3, which obviously you get a time before you have to get to scope 3, the emissions in effect your value chain or your supply chains. So where you buy or sell products, users, etc. Another way to look at that. So what are these scope 3s? The indirect ones that I'm talking about. So it's purchase of capital goods, other energy related activities, business travel, employee commuting, all those sort of things that are inputs into your organizational operations, as well as the downstream or output related activities, which is end of life treatment of your product, transportation, processing of your products or use of sold products, etc. So that is what is the downstream, and they're probably a bit harder to scope, define, and sometimes measure. So I guess a little bit of a practicality. So if you thought about a professional services firm, like say with Dawson, for example, what would our scopes be? So scope 1, we might have some building refrigerants and company vehicles. We happen not to have any. So our scope 1s would really be limited to that, air conditioning, that sort of type thing. Our scope 2 would be purchased electricity in our property that we rent. And our scope 3, so some of our examples would be our employees traveling to and from our office, where they're traveling to clients or conferences or whatever, so that business travel. We obviously purchase some products, a bit of paper, not a whole lot anymore, but computers, IT equipment, those sort of things. We generate some waste, other capital goods. So they're our scope 3 type emissions, if you like. And how would we measure those? In effect, we'd probably do surveys around travel. We'd capture business travel, do surveys with staff around to and from work travel, and use for other types of suppliers. So utilize another professional service firm to give us legal advice, for example, or something like that. We would utilize what's going to be called a spend-based methodology, where there's some available industry data being developed and continuing to be enhanced, where you spend X amount on marketing services or something like that. That would typically relate to this much greenhouse gas emissions. So we'd use industry-based metrics data for the things that are smaller and more difficult to measure if you can't get those directly from your supplier. You would use an industry-based metric. So that's the core of the metrics around sustainability. So there's heaps getting out there at the moment. So the AICD, for those of you board members, they've got guides from a governance perspective. a number of other professional services firms, both accounting and otherwise, starting to do professional bodies like CANZ, CPAs, starting to offer training in this space, short courses, releasing guides, and those sort of things in this space. So if this applies to you, I definitely encourage you to start the journey and start thinking about some of these things. Find out who's interested within your organisation to sort of be the to start to get up to speed and be the champion of this. But likewise, if you're just interested, in potentially understanding your greenhouse gas emissions, what it looks like, and therefore think about how you could improve as an organisation, this will be a standardised framework adopted. So impact, again, for-profit companies, if you've got 2 or 3, start to consider the risks and opportunities. But I'd suggest, you might want to wait for some guidance on materiality before you sort of jump into metrics. But certainly in tier 1 and tier 2, or type 1, type 2 metrics, they're probably things that aren't that hard to start thinking about. There's minimal immediate impact on charities. I do note that if you're sitting there breathing a sigh of relief, pretty confident you won't be material, or you're below the thresholds, it may mean over time you still need to engage. But if you supply to larger organisations that have to report, they may start asking you for data or information, because that you will form part of a larger business's scope 3. If you have stakeholders, grant funders potentially, may start to demand or seek sustainability information. Again, this will become, I think, the accepted framework for that. And I do note that the AASB is looking at starting within their work program next year. They're looking at what should we do for smaller entities. Now, that's just only recently come out. I'm not sure of the driver of that. Next time round, I'll probably have a bit more clarity around that. So as a not-for-profit, you may be out now or not caught by this sort of disclosure at the moment, but it doesn't mean that you're necessarily forever or in the medium term will not have an obligation to do something. I suspect that it would be scaled, but it may be possible that you end up in sustainability reporting at some point in the future to some extent. So that's where I'm going to leave sustainability reporting. But like I said, if you're at the very beginning of the journey, there's lots of information starting to be released, and I encourage you to start to think about, well, what are you going to do? What do you need to do and plan for these coming challenges? All right, the next part or the final piece of this presentation is about Tier 3. So this is accounting standards for smaller and not-for-profits. So if you're a for-profit in the room, and you have no involvement and no interest in not-for-profit financial reporting, I would probably say thanks very much for coming and welcome to jump off. It's not rude at all, and get back on with your day or your lunch. If you're a not-for-profit in the room, or you sit on a not-for-profit board, but you're part of a bigger one, but you're interested in smaller ones or members of smaller ones, trying to understand this, I will now run through this part of the presentation, and I reckon we'll be probably got 10-15 minutes to go max, and so we should finish at 1 o'clock, or by 1 o'clock. So Tier 3. So as I said, not-for-profit, private sector, so not government sector not-for-profit, private sector not-for-profit. The financial reporting framework, this is a new framework. It's been driven by the AASB, have had a long-term goal now, or objective, of removing special purpose. And this is the last piece of that removal of special purpose. Special purpose is already gone for for-profits that have to report under ASIC, etc. This is the removal for the not-for-profits. So come in 4 or 5 years' time, or 4 years' time or so, if you're reporting on the public record, so you're reporting to the ACNC, you're reporting under the Corps Act, you're reporting to incorporated associations, it's highly likely that special purpose won't be available. Now, that doesn't mean a regulator couldn't say, you need to report and you only need to comply with these standards. The AASB probably is hoping that doesn't occur, but that is a possibility. But they are seeking to address the complexity, the level of uplift, perhaps red tape requirement of smaller charities or smaller not-for-profits complying with, in effect, what are IFRS-based accounting standards was considered excessive, really. And so this is their response to that, is to develop a single standard that applies for smaller not-for-profits. An exposure draft of this standard, this has been a 2-year plus project at the AASB. I've been involved with that project, giving on a sort of consultation panel committee meeting every couple of months around all these specific issues I'm about to talk about. So that draft standard has been released. There was a whole lot of feedback provided around the discussion paper, which was released about a bit over a year ago now. And so I think the AASB probably thinks they're pretty much there. And so unless there's a significant amount of feedback about a particular issue, I'm pretty confident that the AASB will be thinking this exposure draft, there won't be a lot of change to the final standard. So comments on the exposure draft, they've given a really good lead time. It closes in February 25. If you jump on the AASB website, you'll find there's 2 exposure drafts. One's the new standard, one's the application for the removal of special purpose. There's also a summary and another guide as well around that. So you want to just get the headlines, and I've used that summary to prepare these slides. So I've got extracts of that summary. It's actually really good. They're inviting feedback. Again, I think they're making the doors really wide for feedback. You can email the AASB, you can do a survey, or you can give formal feedback. So if you have feedback, by all means, provide it yourself to the AASB. We'd really like to hear about it as well, particularly for our clients. So we will do a formal response around what's proposed. When will it apply? So second half of 25, I would expect a standard to be released. And the AASB have said there will be at least 3-year adoption period. So we're talking 28, 29 application, but it's quite likely that early adoption, whenever the AASB releases a standard, almost always early adoption is available. And so I suspect earlier adoption would be available for this standard. So it is private sector not-for-profits. What threshold is unclear at the moment. So it has been designed for smaller not-for-profits, and in the initial design phase, consultation phase, smaller not-for-profits were designed at that medium ACNC charity threshold. So where you've got revenue less than $3 million. What will the final thresholds be? We do not know. And it is not the AASB's role to set it. They've stated that, and I think with reasonable reason. And so it's going to be the regulators, or in effect Treasury, who writes the acts, who will set those thresholds. So it's possible that it will be a higher threshold than $3 million. It could be open. I doubt that it will be open-ended forever, but if the ACNC did, or Treasury did nothing, it probably can theoretically be adopted by anyone. And so if you're thinking about, you go, oh, I really like some of this, I'd like to adopt, and you're above that 3 million threshold, I would express caution before you early adopt it. But we will certainly keep you clear. I think my personal view is that I think it could be the arguments that could apply to someone, a charity of 5 million or even 10 million, maybe plus, are probably quite strong. However, it's really going to be a broader decision made by Treasury, who are sometimes difficult to engage with and input into their decision making. So it's a little bit less transparent than AASB. All right, so jumping into what are some of the specifics in the exposure draft for Tier 3. So I've tried to put these in the headings and then cut out, like I said, these are extracts exactly, these grey shaded items are extracts exactly from the guidance from the guidelines, rather than me rewriting. So there's limitations in opting out. What does that mean? So you can only selectively apply Tier 2. So Tier 2 are the existing standards under simplified disclosure. R&M on these slides means recognition and measurement. So the rules for how do you record a transaction in minutes. So you can only opt up to Tier 2 where Tier 3 doesn't specifically address an issue, and I'll give you a list of some of those things, or it's an omitted topic, and therefore you would look to Tier 2. Otherwise, you cannot selectively apply Tier 2 for some things and what's set in Tier 3 for others. If you want to opt up where Tier 3 actually addresses the topic, you have to opt up into everything in Tier 2 and in effect become elect to be a Tier 2 employee entity. So Tier 3 doesn't cover this list. And the reason why is it was decided that for those smaller end not-for-profits, these things were rare. I note that Tier 3 does address financial instruments and employee benefits, employee leave entitlements, etc., to an extent, but there's sort of carve-outs for specific issues for employee benefits, sort of like share schemes and things like that, and complex financial instruments are also not addressed in the Tier 3 proposed standard. So what entities would report under Tier 3? So at the moment, Tier 2 has concepts of control, related party standards, etc., to work out, do I have to report as a consolidated group if I'm preparing financials under Tier 2? Tier 3 introduces this concept of a notable relationship. And so it reduces that complex analysis over do I control or not. And so where you have some sort of significant influence, etc., or notable relationship, you just have to identify them. You don't have to go through the whole requirement of have you met the definitions of control, etc., which is really complex for not-for-profits. And you've heard me speak before, I think it's a real issue under the accounting standard that still needs to be addressed. So once you only have to do that, the question becomes, well, what do I do about consolidation if I'm not assessing this pure definition of control or not? So you have a consolidation choice. So if you have these notable relationships / subsidiaries, you can prepare standalone financial statements. So in effect, not adopt or not consolidate. However, if you choose to consolidate, you need to consolidate all subsidiaries, and you will need to go through, do I actually meet the definitions of control to do that consolidation piece, if you want to look at that. So there's certainly some relief there around consolidation, but you're a bit all in or not around subsidiaries. You can't just choose to do some and not others, but you can choose to do standalone. So if you choose to do standalone, there's some requirements around, well, how do I record if you have an investment in a subsidiary or another entity? And basically you get a choice around cost, fair value, or applying an equity method for those elections for investments in entities that you have a notable relationship in. If you have an entity combination, so this is where you acquire another entity, you do a merger, and you either you acquire in effect the operations or business out of an entity. That's a complex piece of accounting, and so there's some real changes here. And so the first one is that you acquire or you record the assets and liabilities at the pre-combination value. So in effect, what did the other entity do? What were their balances? You pick them up unless they're clearly not in accordance with the Tier 3 accounting standard requirements. performance, and therefore, and if there's not and something's missing, just left out, so the entity just didn't book their leave entitlements, for example, you would have to record them. And you can record them at fair value. However, you don't look at the date you obtained control of those operations. You actually go back to the beginning of the financial period and assume you actually got control of them at that point, because that's when there's clear balance dates, reconciliations, presumably likely assurance, and those sort of things. And you record from that period. And you do not recognise goodwill or discount on acquisition for the difference between what you paid, which may be zero, and what you got. You record the net impact of that directly in equity. So you in effect create a reserve for the difference between what you paid versus the net assets you acquired, straight to equity. Totally different from tier 3. From tier 2. So no goodwill, no discount on acquisition, no P&L impact. So really different, again, from tier 2. Related party disclosures. So you do have disclosures around those notable relationships, etc. But I note that some of the problems with related party coming into the not-for-profit space, mandatorily by the ACNC a year or so ago, has actually been addressed in the standard. So first of all, you're not required to disclose key management personnel compensation for small ends. You're also not required to disclose donations from related parties. So again, it was a problematic area where board members, for example, gave donations, unless those donations could influence the entity's activities or use of resources. There's a bit of judgment involved in that one, but that's a really interesting, in effect, carve out or reduction in related party disclosures. Sorry, I will go 5 minutes over time, just if you're hanging in there. So sorry about that. Got a bit carried away at the beginning of this bit. In relation to accounting policies and errors, so under tier 2, when you change accounting policies or you identify that there was an error in the prior year, we go back and retrospectively adjust that. Under tier 3, you do not. You simply make an adjustment to the opening balances of the current period. So no prior period adjustments, even for errors that you're being corrected. So again, it's quite a significant change. In relation to PP&E, so at the moment, there's a couple of things. So one is around borrowing costs. So if you're building a piece of property or something like that, you often capitalise borrowing costs. Under tier 3, borrowing costs are always an expense. There's no ability to capitalise them. And in relation to donated property, plant, and equipment, so that could be property, it could be a car, it could be inventory also, which I haven't put on the slide, but it's the same. You have a choice to measure at cost or fair value. I note that if someone donates you, gives you a piece of property, for example, a house, that cost is zero or minimal. So you will in effect not have to record that at fair value. Again, that's a significant adjustment compared to compared to tier 2. This is only for PPE intangible type inventory, so physical type assets. Financial instruments, so someone gave you a share portfolio, for example, fair value for that one. So financial instruments do not get that carved out. For impairment of property, plant, and equipment, again, it is not a significant, there's issues in relation to this because not-for-profits use PPE not to generate cash flow sometimes, etc. And so impairment can be tricky. So what they've done in tier 3 is introduce some, practical indicators of impairment, and that's where something's physically damaged, you're no longer using it, or there's change in external demand, etc. Then that's an impairment indicator, which means you then potentially write it down to its value in use or fair value less cost to sell. And typically the presumption is that's fair value less cost to sell is the most appropriate in those circumstances. And so impairment becomes a bit simpler, particularly from a technical end under tier 3. Intangibles. For intangibles, you cannot capitalise internally generated anymore under Tier 3, or you won't be able to. And so I would expect to see lower values on the balance sheet. For intangibles, for all other intangibles where you're purchasing or have an external cost in relation to those, you are required to amortize those, and you will write them off over a maximum period of 10 years. Okay, so you don't get indefinite or infinite life anymore where you're not amortizing for anything. I think that was difficult to get to anyway, but certainly that door's closed and you don't get long life beyond 10 years. I note also that there's no further consideration of sort of cloud software as a service type arrangements, which is problematic. So you still remain probably in an expense scenario where you don't control the underlying code, etc. for those circumstances. Leases, if you all turn your microphones on, I'm sure I could hear cheering. Leases will no longer be on the balance sheet for Tier 3. You expense them as you, in effect, incur those costs or on a straight line or systematic basis over the period that you use those. So again, many of you did not like it, went to special purpose or stayed at special purpose because of lease accounting. So that is far closer to what we used to have. So I'll be back to the future moment there. For revenue, again, revenue recognition is a complex area for not-for-profits. So you get to deferral a lot easier than you do under AASB 15 in Tier 3. And I think you'll be able to structure your arrangements to actually get to the result that makes sense for you as opposed to the result you might like. But where you have between the funder or the provider of the funding and your own organisation, where you have common understanding that would typically include some sort of written communication or correspondence for the purpose of that funding, or the amounts to be, how it's going to be transferred or used, or period that funding applies to, you can get to deferral and then recognise the revenue as the funding is in effect spent or over a relevant period. And so you get to matching far more easily than you do under AASB 15. So again, I think organisations, if will communicate with the philanthropic donors and those sort of things around what the use of the funds is for, and get a common understanding. Again, it gets to deferral, even though you might not AASB 15 under Tier 3. Likewise, donations for a specific cause, event, etc., where that's on a website, make a donor tip a button, they now have common understanding, etc. That can be, I think we'll be able to, again, get to deferral. So it probably allows that matching, again, a lot more easily and under without a whole lot of rigorous testing to enable you to get there. So again, I think that's something that many not-for-profits would really be interested in. Employee entitlements. I note that particularly for long service leave, the whole discounting, increase in wage rates, etc., that gets removed. However, for long service leave, there's still a probability requirement for those employees that are not yet legally entitled. So more simple, but not extremely simple. So they've left that. So that's really the summary of Tier 3. Like I said, get back to the standard, have a look at those other guidance statements released by the AASB. Entities over that threshold, again, not sure what the threshold is. I think you will be in Tier 2 GP SDS 2829. I do note that the AASB does have a consolidation project for not-for-profits, has been ongoing for a fair while. It basically got deferred for the last more than 12 months. It's now scheduled for the first half of next year. So again, I'm aware of a number of you have concerns around consolidation of tier two. At the removal of special purpose, it's still ongoing. And finally, just a disclaimer. So again, just like to really thank you all for, hopefully I've stopped sharing. Thank you all for coming and being a part of this. I'll just check whether Matt's jumped on to see if there's any other questions around anything that we've covered today.
Thanks, Jeff. No, there's no significant questions to sort of go through. Good presentation, nice and clear. Just on tier three, I recognise you've gone over time. You've done a lot of work over the last few years in advocacy and consulting and working with the AASB on this. Do you think it's arrived at a reasonable space for medium charities, considering compliance with accounting standards, considering, you know, the size of those organisations and things like that, and some of those specifics for those type of organisations? Do you think it's landed at a reasonable spot for those type of organisations?
Yeah, I do. There's been a small number really of consistent voices, and so, you know, something that you know, took a fair bit of my time, but I was really interested in trying to advocate on behalf of our clients in the sector that, you know, it's difficult for smaller organisations to try and engage with AASB and advocate for them. I think they've landed on a really good result. Revenue, leases, I think, as we expressed my view before, I don't think it really makes sense that they're currently standard as conceptually. I was never a fan of it. I think there's a very different reason to borrow or finance versus rent, and yet the standard sort of puts you in the same bucket. Right, the significant differences between those two options, and so I think leases out makes a lot of sense. Consolidation, again, I think giving organisations choice to go, when does it make, hopefully they make a choice based on when does it make sense to a user of these financial statements to put some organisations together versus to leave them apart. I think that's a really practical solution. Some of the other things, I think they have tried to make it more simple. There was some potential removal of choice, and I advocated hard that simplicity doesn't mean removal of choice. Choice can still be simple. And so I think they got some, they backed off on some of that where they were trying to funnel everyone into a very narrow level of choice or had to do things particular ways, particularly where tier two had choice. And so I think we've ended up in probably quite a good result. Again, I'd probably be keen to see a threshold personally a bit higher than the 3 million, and we'll probably advocate for that, as well as, you know, what is the application of some of this to larger organisations? Given you spent all this time and you've decided these accounting standards are a bit complex, why not let larger organisations apply something like that? So yeah, that's my overall question. But yeah, really interested in hearing if you've got specific feedback, you really don't like something. Again, that group is still meeting, and I have direct access really to AASB staff around these issues. So happy to hear any feedback from anyone.
Yeah, one question that has just come through, and I haven't responded to. Just wondering what you think about the Productivity Commission's report future foundations for giving draft report proposal to remove BRC and how it would affect BRCs. Probably a longer answer, but maybe a quick response to that.
Yeah, so I understand that approach. My understanding is lawyers are better placed to answer technically, but I asked them that question. So not seeing a lot of rumblings around the BRC potential for removal post that, the Productivity Commission. I think there's some problematic requirements in the Constitution and, as I understand, for regulation of religious organisations, which is what a BSC is. So we're probably not seeing a whole lot of quick movement on that. However, I would caution that, you know, BRC concessions may not always be there, and just be aware of that. From my perspective, the some of the tax concessions like exempt fringe and things like that. I'd be aware of that risk that, again, religious institutions have, BRCs have, is probably, I think that might be a bit bigger risk for them. And it really is only going to take, my caution is that, if we've seen things hit Parliament and people saying stuff or momentum being gained under at a political level, and I think some bad press in the religious space, etc., could bring BA on.
No, looks like Jeff has just cut out. I don't know if you can hear me. We might end it there. I'm not sure what's happened with Jeff's presentation there, but thank you for joining in to the presentation. If you've got any questions, please feel free to send them through to us. Thanks for joining in.